Hey everyone, and welcome back to the Noob Selling Options channel. I am so pumped to be hanging out with you today. Real quick, before we jump into the deep end, do me a huge favor, hit that like button, and if you haven't already, subscribe to the channel to support the community. We've got an absolutely massive explainer for you today. We're looking 5 years down the road to 2031. We are strictly relying on the hard data and institutional structural models to answer some really big questions. Specifically, we're going to break down the 5-year architectures of the two absolute titans of the smart contract world, Solana and Ethereum.
Okay, so here's our roadmap for today's explainer. First up, Solana, the sports car. Second, Ethereum, the cargo train. Third, we'll get into those juicy 2031 price models. Fourth, we'll look at the macro levers that could totally shift those estimates. And finally, we're going to answer the big one. Is this a generational buy opportunity? Let's get into it.
So to really grasp what's going on, we have to start with this brilliant core metaphor from our sources today. Think of Solana as a high-performance sports car. It's built for blinding speed, high-velocity retail action, and just rapid execution. Ethereum, on the flip side, is a literal multi-trillion-dollar commercial cargo train. It's heavily armored, it moves incredible amounts of institutional value, and it does it with absolute, unshakable security. Understanding this fundamental difference, that's the absolute key to understanding where their 5-year roadmaps are headed.
Section 1. Solana, the sports car, and its 5-year survival muscle.
Here is the massive takeaway from the data. Solana has successfully leveled up. It transitioned from this highly speculative, experimental retail chain into a very real, foundational piece of institutional infrastructure. And survived the trial by fire, guys. Wall Street has officially moved in. With spot ETFs and giants like Goldman Sachs and Morgan Stanley stepping up, the asset is getting anchored by serious long-term buyers. Because of this huge institutional pivot, the real-world economic activity on Solana is staggering. I mean, its low fees are driving network revenue to fiercely rival Ethereum's. And to keep that momentum going, you've got Jump Crypto's Firedancer upgrade. They're targeting a mind-blowing 1 million transactions per second while also squashing past stability issues. That kind of speed and sub-cent cost makes it the undisputed home for DePIN, decentralized physical infrastructure networks like Helium, and massive global payment integrations with heavyweights like Shopify and Stripe.
Now, to be totally fair, a 5-year horizon naturally brings some serious structural headwinds. It's not all sunshine. New parallelized blockchains like Sui and Aptos, they are putting up a vicious fight for developer mindshare. It is an intense Layer 1 competition out there. On top of that, as a major platform with an active ETF market, Solana is super sensitive to global regulatory shifts, especially when it comes to staking yields and governance. We also just have to factor in the reality that crypto moves in macro cycles. Standard multi-year cooling periods are basically inevitable before this network reaches full, undeniable institutional maturity.
Section 2. Ethereum, the cargo train. Navigating the value paradox.
So looking over the next 5 years, Ethereum's survival isn't even really a question. The data shows it's virtually a certainty. It acts as the ultimate unkillable plumbing of global finance. Why? Well, it starts with the Lindy effect. That's the idea that the longer something survives and operates securely, the more robust and trusted it actually becomes. Ethereum has this deep historical dominance and security that newer chains literally cannot buy. And because of that established trust, it is the absolute hub for real-world assets. We're talking BlackRock's BYDL fund and the tokenization of treasury bills. This brings in sticky, institutional liquidity that anchors Ethereum directly into the legacy financial system. Add to that the massive, undeniable success of its Layer 2 rollup strategy, offloading transactions to networks like Arbitrum and Base for fractions of a cent, along with its status as an institutional-grade asset with spot ETFs, and you have an incredibly robust foundation.
But here is where it gets really interesting. Despite that rock-solid foundation, Ethereum is navigating this fascinating structural identity crisis right now. Our sources call it the Ethereum versus ETH dilemma. By intentionally making those Layer 2 networks super cheap and efficient, Ethereum basically succeeded in pushing user activity off the main chain. But here's the catch. Because the mainnet isn't congested anymore, gas fees are low, which means the famous ETH burn mechanism has slowed way down. Critics are arguing that this is cannibalizing the value of the actual ETH token. On the flip side, proponents argue that as Layer 2 activity just absolutely explodes, the sheer volume of data being posted back to the mainnet will eventually drive a massive, steady economic burn. It is such a compelling paradox to keep an eye on over the next few years.
And that dilemma feeds right into Ethereum's incredibly methodical, industrial-grade roadmap, which developers are calling the Strawmap era. The next 5 years look so deliberate. It kicks off with PeerDAS, which is going to exponentially expand the data capacity for all those Layer 2 networks. From there, ZK-EVM integration embeds zero-knowledge proofs natively, pushing the whole ecosystem's throughput toward an astonishing 100,000 transactions per second. And looking even further out, they are proactively focusing on quantum readiness. Yeah, literally future-proofing the network's consensus against potential quantum computing threats. This is infrastructure being built to last for decades, not just a couple of bull runs.
All right, Section 3, the 2031 price models. Let's analyze the structural market models.
Shifting strictly to the structural models and institutional growth projections for 2031, let's talk numbers. Solana's estimates show a really wide range. The bear case sits between $150 and $300, which basically assumes a heavy macro drag or the network losing a significant chunk of market share to competitors like Sui or Aptos. The base case, where a lot of the aggregate models sit, projects $800 to $1,200. For that to happen, Solana needs to comfortably hold a $400 billion plus market cap driven by steady institutional ETF inflows and the utility unlocked by Firedancer. Then you have the bull case, pushing a massive $2,000 to $3,500. This is a scenario where Solana captures over 15% of the world's decentralized app layer and handles major, global retail payment settlements completely natively.
Now, what about Ethereum's structural estimates? The bear case projects $3,500 to $5,000. This plays out if that Layer 2 fragmentation we just talked about actually cannibalizes the token's value, leaving us with flat inflation against the broader global economy. The base case jumps up to a hefty $10,000 to $15,000. This assumes Wall Street successfully tokenizes trillions in real-world assets right on Ethereum, and traditional asset managers structuralize a 1 to 3% portfolio allocation into ETH spot ETFs. The bull case is just staggering. $22,000 to over $30,000. These extreme projection models envision a world where a massive portion of global securities and corporate treasuries are running entirely on Ethereum's zero-knowledge infrastructure.
Section 4. Shifting the macro levers. What are the variables actually altering these estimates?
So why are those price ranges so incredibly wide? Well, compounding math over 5 years is wild, and it's highly sensitive to a few massive macro levers. These forces act like gravity on the 2031 estimates. The biggest one is the staking yield shift. If regulations finally clear up and allow institutional ETFs to pass that 3 to 4% staking reward directly back to traditional investors, both networks are going to attract massive, sticky capital pools that treat them almost like dividend-paying tech stocks. Furthermore, we got to watch the inflation versus burn dynamic. Solana has this declining structural inflation rate that bottoms out at 1.5%, while Ethereum has the potential to be deflationary. If network burn mechanisms don't outpace token emissions, it puts a hard ceiling on price growth. And underlying all of this, the macro liquidity cycles. Crypto moves in lockstep with the global M2 money supply and central bank interest rates. By the time we hit 2031, we'll likely be sitting near the mature tail end or early accumulation phase of a completely new liquidity cycle.
Finally, Section 5, a generational buy opportunity, the 2031 verdict.
Bringing all of this together for you guys here at the Noob Selling Options community, the sports car, the cargo train, the roadmaps, the macro levers, we arrive at the ultimate question. Considering the Lindy effect, the incredibly deep institutional backing moving into the space, and the impending multi-year macro cycles, is right now a generational buy opportunity? Well, the data we've reviewed suggests that yes, while there will absolutely be intense volatility and cyclical pullbacks along the way, the underlying infrastructure of both Solana and Ethereum is cementing itself deeply into the global financial system. The wild speculative phase is ending. The institutional utility phase is truly beginning.
I want to leave you with this powerful quote straight from our institutional sources today. Barring a catastrophic, unrecoverable code exploit, Solana is highly likely to remain a top 3 smart contract platform alongside Ethereum 5 years from now. If these incredibly complex, highly secure networks are truly becoming the unkillable plumbing of decentralized finance, what does that actually mean for your long-term 2031 thesis? Really think about that as you evaluate your own portfolios. Thank you so much for hanging out with me for this explainer today. And again, please like and subscribe to the channel if you found this deep dive valuable. It really helps us out. I'll see you in the next one.